Hi, I'm Alexandre Ferrari with Ferrari Lending. If you've been researching DSCR loans to finance your next investment property, you've probably seen phrases like no income verification or fast closings. That's all true. But here's what most lenders don't explain clearly: the real costs associated with DSCR financing. Today, I'm going to break down every component that affects your rate, your fees, and your overall investment returns, so you can make an informed decision with confidence and avoid surprises at closing. Let's start with why DSCR loans are priced differently from traditional mortgages. A DSCR loan is a non-QM loan. That stands for non-qualified mortgage. It's designed specifically for real estate investors who don't fit the standard mold of full documentation lending. Because the lender takes on more risk by not requiring tax returns or income verification, they compensate for that flexibility through slightly higher rates and tighter equity requirements. It's not a penalty, it's the price of freedom. You're trading paperwork and underwriting headaches for speed, simplicity, and flexibility. But let's talk about the number that gets everyone's attention first: the interest rate. On average, DSCR loan rates run about 1 to 2% higher than a conventional mortgage. For example, if traditional investment property loans are at 7%, you might see a DSCR rate around 8% or 8.5%. That rate range depends on 5 main factors. 1. Your credit score. Higher credit usually means better pricing. 2. The property's DSCR ratio. A higher ratio shows stronger cash flow and earns better terms. 3. Your down payment. More equity means less risk to the lender. 4. Loan purpose. Purchase, refinance, or cash out each carry different pricing. 5. Prepayment flexibility. The shorter your prepay penalty, the higher the rate. When I structure DSCR loans for my clients, I look at all of these to find the balance between rate and flexibility that fits your investment strategy. Now let's look at loan points and fees, which can be confusing if you're new to non-QM lending. Most DSCR loans include between 1 and 2 points in origination fees. That's 1 to 2% of your loan amount. So on a $400,000 loan, you might see $4,000 to $8,000 in origination costs. Then there are standard lender fees, which typically range from $1,000 to $2,000 depending on the lender. These cover underwriting, document preparation, and funding coordination. Next, you'll have your third-party fees, which are the same as any other mortgage: title insurance, escrow, recording, and appraisal. Appraisals for DSCR loans include a special rent schedule form. It's called the 1007, and that can add about $150 to $250 to a standard appraisal cost. In total, most DSCR loans cost between 2.5% and 5% of the purchase price when you add up points, lender fees, and closing costs. That may sound high compared to a conventional loan, but remember, DSCR loans unlock deals that traditional lenders simply won't approve. Here's something most investors overlook: the prepayment penalty. Almost all DSCR loans include one because they're designed for long-term rental investments, not short-term flips. The most common structure is a 3-year or 5-year prepay period with either a step-down or a flat percentage. For example, in a 5-year step-down, the penalty might be 5% the first year, 4% the second, and so on. But many investors choose to buy that penalty down, paying a slightly higher rate in exchange for more flexibility. The key is aligning your loan structure with your investment horizon. If you plan to hold the property for 3 years or longer, the prepayment penalty won't be an issue. That's why understanding the fine print upfront is critical. Now let's cover a few costs that don't show up on the rate sheet but still matter to your bottom line. Some lenders have minimum reserve requirements, usually 3 to 6 months of mortgage payments in the bank. You'll also see loan level pricing adjustments for things like short-term rental properties, lower DSCR ratios, or condos in certain markets. And if you're a foreign national, you may see an additional 1 to 2% pricing adjustment because of the higher perceived risk and international documentation. The good news: every one of these can be managed strategically when you structure the loan the right way. Now let me reframe how you think about cost, because this is where smart investors separate themselves from average ones. The cost of capital isn't what matters most. What matters is the return on that capital. If your property generates consistent rental income, appreciates over time, and builds equity while your tenants pay the mortgage, the loan becomes a tool for leverage, not an expense. When you understand that mindset, you'll see why experienced investors rarely fixate on the rate. They focus on scalability, asset control, and long-term portfolio value. Here's the bottom line: DSCR loans are not cheap money, they're strategic money. They let you acquire income-producing assets faster, even when traditional banks say no. The key is working with someone who knows how to structure these loans correctly, minimize unnecessary fees, and align the cost with your investment return. If you'd like to review your numbers, I'll personally help you calculate your DSCR, estimate total costs, and determine whether this strategy makes sense for your situation. You can reach me directly at Ferrari Lending or visit ferrarilending.com to schedule a one-on-one consultation. I'm Alexander Ferrari. Thank you for watching. And remember, smart investing isn't about finding the lowest cost of money. It's about finding the smartest use of money.